Over the next few weeks, the SAMRRA Old Mutual Alternative Investments Multifamily Series will take you through a number of key topics showing how multifamily is a defensive, investable asset class. I will be joined by the institutional landlord CEOs alongside key fund and asset managers and pension fund executives. The series will be educational to trustees and decision makers and will clarify some standing misconceptions about the industry. Welcome to another episode of the SAMRRA Old Mutual Alternative Investments Multifamily Series. Today I have with me Kevin from AFHCO and Kundayi from Sesfikile Capital. Before we get going, I'll ask them to quickly introduce themselves and what they do in this space. Kevin, go ahead.
Thanks, Palesa. Thanks for the invite. So Kevin van den Heever, Managing Director of AFHCO. Been with the business for 20 years now, so been in the space for a long time. We are part of the SA Corporate Real Estate Stable, so the largest institutional listed investor in the multifamily space.
Kundayi, can you give us a little bit more about yourself and Sesfikile?
Okay, thanks, Palesa. My name is Kundayi Munzara. I'm a co-founder and portfolio manager of a company called Sesfikile Capital. We're an asset manager, so we invest on behalf predominantly of South African pension funds and individual investors, and we invest all of that into listed property companies. Most of our business involves investing that capital domestically, so JSE listed property companies like SA Corporate. That's a good example. And then we also have another part of our business which invests offshore, and that would be offshore developed markets, North America, Europe, Asia Pacific, and been in the business since the inception, which is December 2010, so we're just over 15 years old now.
Okay, great. This is set to be a very interesting discussion given your two profiles. Kevin, we want to talk a little bit about, inside the engine room. Residential rental is described as operationally intensive, which is perhaps the polite version for it's relentless. What can you tell us from your perspective about what it's like running thousands of individual leases as opposed to, in the commercial space where guys run 5 or 10 or 15 per building, so to speak?
Yeah, so Palesa, it does certainly sound daunting that you're managing thousands of leases, as you put it. From AFHCO's perspective, we're a 30-year-old business this year. We grew out of the inner city, which some would regard as daunting. And so I think through the years, we've earned our stripes in terms of the management we've undertaken. Today, we manage approximately 16,500 apartments.
Sure.
We believe we one of, if not the biggest institutional landlord, residential multifamily landlord in the country. And that's apart from the other aspects of the business, the student side of things, as well as the retail that comes with the nature of some of the buildings. But surprisingly, it's not as relentless or chaotic as some would believe.
Yeah.
And I think that is a big part of the misconception about the resi. Yes, it does take dedicated, hands-on management, which is different to other asset classes. And not to suggest that those asset classes are easy.
Yeah, of course.
I'm sure they have their own challenges in that.
Yeah.
But I think the volume of it is part of the opportunity in it. And I think if one looks at how management has evolved over the years, and I'm sure we'll get into some of that a little bit later in terms of the digitization, where things are going with AI and the like, it has become a lot easier to manage large-scale residential. The old days of manual work
Leases.
has been replaced with digital leases. As I say, we haven't even touched on what AI is going to do in the space. And so, yes, it takes a big team. It takes a lot of team effort, but with the right systems and the right people, it makes it surprisingly easy.
Yeah.
Of course, there's the challenges, but yeah, not as daunting as some may believe.
I feel like it's the 20 years speaking, Kevin. You've done it so long, you might not know that it's daunting. But no, I think what we're hearing from SAMRRA members is exactly that. What you're saying resonates, is that when you're built for it, it's not relentless. When you know exactly how to manage these assets, and when you're a mature property and asset manager, it's something you do on the daily, and you build for it, as you do in any industry that requires you to take care of thousands of individuals, because ultimately that's what you're managing, right? A lot of people, a lot of warm bodies inside every single one of your 16,500 units.
No, that's true. You're very much a consumer business. You're very different to a commercial landlord that is not so much a consumer business. We are very much about the consumer. We spend a lot of time and effort nurturing the relationships with tenants, and that's part of the success. I think that's one of the specialities with the residential sector, and there's some very credible, large institutional landlords with really exceptional management teams, property management teams. And you have to have your finger on the pulse. That's the reality. It's not something to outsource.
No, you can't do it online. You can't do it remotely.
No, I firmly believe this is something you have to manage and nurture yourself.
Perfect. Kundayi, while you spoke about all the investments you guys make, that comes with a lot of analysis before you make all those investments. When you are looking at a business that's got multifamily, be it your portfolios abroad, your exposure to SA Corp, Octodec, what is it that you're trying to figure out? What are those key metrics that these businesses need to kind of show you before you get interested, so to speak?
Sure. I think, the depth of the multifamily market domestically, in the listed environment anyway, is still very shallow. I think it's, we said earlier, maybe a percent or
2%, yeah.
of the total listed property market in South Africa is in the residential space. If we contrast that to what we see abroad, that's about 13%. So it's a much bigger market. But there are different nuances. Now, to kind of get to answer your question, is ultimately, as a investment analyst or a portfolio manager, what you're trying to do is to find value in understanding the earnings power of companies, right? Or assets. So ultimately, when we're looking at multifamily, what we found domestically, and I think internationally as well, there are two key kind of top line drivers. And I would say one of them is, there's supply and demand and all these things, but these are true for any sector, right? But particular to apartments or multifamily, we think job growth or wage growth in a microeconomy or in an area is important, and wage growth as well. So that sometimes gives us a sense of the consumer or the tenant's ability to bear rental increases over time from a top line perspective. So if a microeconomy is creating jobs, there's more people available that could rent space, and those wages are growing. Those are kind of two important drivers for multifamily in general. That's what we found. So in some ways, it's a very defensive sector because, you cut back your DSTV, you cut back all this stuff before you cut back your rent, right?
Of course.
Because you got to live somewhere. But you still are kind of subject to how much your income is going to grow as an individual, and if you're actually employed. So those are the two kind of top line drivers. But when we start to go lower down at the companies and say, what is your kind of efficiency ratios? We would want to see your cost to income ratios in general. And just really, that's a sense of how well you manage those properties. And how much of the rent are you keeping back as the landlord, or are you kind of ending up with as the landlord?
What's left after
What's
everything
left
comes
after
off?
you pay your rates and all of this stuff, and things break and all of that stuff. Those are key aspects for us when we look at multifamily, and I think within that, I would say that's where a lot of the noise is, or that's where a lot of the action is your ability to actually collect. And something, we maybe we'll speak later in the discussion is, we think there is a bifurcation between your kind of CBD type tenant versus your suburban tenant. And when we're looking at local or global markets, the differences do show. So it would be interesting just maybe to ask you around that later. Yeah.
I mean, I think Kevin's going to be expert at that. I saw him recently and I said, AFHCO is a big CBD operator. And he said, no, not quite, because that portfolio has taken different shape now. And there was quite a significant recent transaction that you did with House. I think it was about 1.6 billion rand out in Midrand, Riversands. Yes. But we'll get to that later. Kevin, Kundayi has said quite a few things about what it is they look at. Does that resonate with you? What are some of those operational costs that you think also blindside guys who, start their foray in residential? What's that one thing that chomps at your rental income, so to speak?
Yeah, Palesa, so maybe I wouldn't say it's one thing. I think in South Africa, we've obviously got maybe not unique, but a challenge in local municipal and the state of service delivery, which includes billing, accuracy, and the like. And I think what people underestimate is the demands to deal with the local authorities in respect of billing issues, service delivery failures, and the like. That's something that you can't solve with a system.
You can't mitigate.
Or through AI. And so, your human capital cost around that element remains quite high. But it's a necessary. We all deal with, and this is not specific to residential. It's across all the sectors, the municipal issues. But again, as we say, when you're dealing with a consumer business, people want remedies to the problems, the service delivery issues and that. And so one finds that possibly in the costs, and maybe this comes to your point maybe about the inner city in that, the one maybe obvious difference between inner city and suburban is that obviously geographically you're very contained in that environment, and so you feel the service delivery issue more. And the landlord is spending more and more to address some of those issues, the security, the cleaning, and the like. And so that's one cost that is not necessarily typically costed into the model and that. But again, that's not unique to inner city either. There's examples of failures all over the place. So I'd say that's one. The second would be unit churn. That unless you've got your handle on unit churn, because vacancy, you can predict vacancy all you want. That's just a number in a model. But churn can really eat away at your NOI. And so you need proper processes to be able to deal with that type of thing, because it can get away from you.
My sense is that because some of these things, especially the churn story, you build in the capacity to deal with it. In an earlier episode, we discussed with House, and Vanessa spoke about 300 people moving out and 400 moving in. And that's just the nature of the business. But what you're saying is you, without a doubt, have to be built for it. And people could discount just how intense that is and how important it is.
And sorry, to put it in perspective, on a portfolio of our size at a churn rate of 3%, you're talking about 500 movements a month. But again,
that's 500 keys.
You need the people and the systems to deal with that, which obviously we do as part of the platform we have.
You have.
So your churn is 3% per month, roughly.
Yeah, it can be
Okay.
between, it's property dependent,
Yeah,
but I'd say
sure.
on a portfolio level, you're probably talking about
Okay.
2.5% to 3%.
Okay, not bad. So 36 in a year. People stay 2 to 3 years, roughly.
We're seeing average occupancy, strangely, since COVID, we've seen it climb. So, through my 20 years, we've seen it go from 18 months to 24 months, and it's steadily hitting 3 years plus.
That's
Good.
incredible.
That's good.
Yeah.
Okay. It's
And I think some of that had to do with COVID. I found that there was and this is my personal view, that COVID in some way reset people's thinking about movement.
The four walls around you
Yeah,
and making them stable.
And so,
Yeah.
we've just seen more stability in that. But having said that, we also spend a lot of time and effort, as we say, nurturing those relationships to make sure people are happy to continue staying.
Yeah.
It's not, people move for different reasons.
Yep.
Employment, they could move different province, that you're not going to stop.
No.
But when you are faced with lots of opportunities or options, you need to do the best job you can to retain the tenant, and be that through good service, affordability, not cheapness, but affordability, and just how you manage relationships and what you offer.
Kevin, just on that, are you seeing technology really being something significant in helping you manage the churn, in helping you get people to stay longer, extending those leases? Has technology been the good story here in your 20 years, or is it still a bit nascent? Like, are you slowly getting yourself there?
No, look, I would again, different markets have reacted differently to technology in that. So in the acquisition you referred to earlier that we made in December, given that is a higher LSM market in that, technology is adopted more easily. Whereas in a lower LSM, not to the same extent. But there are certainly management tools from a technology point of view that make managing it easier. Doesn't mean to say that it has to be tenant facing necessarily. But it can, from a pure management point of view, the technology certainly helps.
Yeah. So I'm guessing those digital leases and the likes.
Correct, yeah. 20 years ago, everything was manual. Today, if you don't have at scale, if you don't have a digital system that not only does the digital leasing, but also integrates into your system so that you don't have a human body capturing the lease, that's all gone. Yeah. And that's where the benefit of digitization has come about more recently, I would say. Originally, it wasn't a case of, you get a system, you switch it on, and all of a sudden your costs come down. That wasn't the case.
Okay.
I think there weren't a lot of platforms capable of doing a lot of what we do today. And so it was a slow journey to build up the technology stack, and that today we're in a much better space. Software as a service, you can plug in, you can integrate. And so we've seen a lot of benefit coming through from that. And we'll continue to see that with AI. I think that's going to be, potentially a game changer in terms of the cost structure in management.
So you're seeing efficiencies is what I'm hearing.
Absolutely.
Something else that I forgot to answer you on the ratios, and it sparked, it kind of came to me when you spoke about affordability, is another ratio we look at is the ratio of rent to disposable to income.
Okay.
And what we found
for the consumer.
So just looking at the affordability of that unit or that portfolio. US, what we found is the apartment space, the multifamily space, is kind of between 25 and 27% of income is a rental. UK probably around 27, 28%, not central London, but kind of general UK. And that's an important ratio for us to see effectively your ability as a landlord to keep raising rents over time. Now, the question I would like to ask when looking at maybe your CBD market and maybe less so your suburban market, just in kind of your 20 years of experience, is I've always thought, and this is partly from experience, I made an attempt at being a individual landlord in the CBD myself. I'm still there, but obviously not at scale. And my concern has always been about an affordability cap. So you can hike rents for time, and that level kind of gets to like a cap where the consumer just can't bear escalations further. And that's probably speaking to just too much of a high ratio relative to the income. And just my question is more, what's your experience around that in CBD? Or can people just continue to see kind of 6% escalations every year, kind of into?
Look, I think we haven't been doing 6% escalations for some time. I think we've seen steadily in our our results obviously reported in the market, and we've seen that it has climbed over the last 3 years. I think we're back to above inflation now, just over 4%. But I think again it comes down to both markets have a range of people with affordability levels.
Yeah, sure.
The inner city itself doesn't necessarily have everybody that is constrained. That ratio can range from 15% to 30% in the inner city. It just depends really on the person's income, obviously. And it's surprising you have a lot of good income earning individuals that want to stay in the inner city.
Okay.
It's not a case of it's just for an affordable market.
100%.
It's got it, there's the wrong perception about it.
Okay.
I always quote an example from 2013 when we released a product that was really intended for the lower LSM, where rentals were starting at 1,400 rand. We did 2 magnificent conversions, with communal facilities, very tasteful, all of that, and we had somebody who was earning 100,000 rand wanting to live in the building.
Okay.
We said, no, you can afford a lot more than this.
Yeah, sure.
And they were adamant.
That's what
they wanted to stay there.
Yeah. Okay.
And so again, I think there's a misperception about who rents in the inner city.
Gotcha.
It covers a broad range of people. There's big employers in the inner city, the ABSs, the Standard Banks.
Yeah.
A lot of their employees obviously take up occupation in that. So
Gotcha.
Yeah. Kundayi, further to that, what we're seeing is that some of our members in Johannesburg can keep it at about that 30% to disposable income. But in the Western Cape, they're finding that it's at about 50%. And guys are happy to apply and say, no, I know the rent will be 50% of my income. And our members have been absolutely astounded at how that's a bit of a norm.
Sure.
And when I speak to professionals who are living at the waterfront, they tell me, 50% of my income goes to rent.
Oh my God.
So there are definitely nuances that we're starting to see, and I think the work we're doing towards gathering data and starting to figure this out should hopefully help organizations like yours to start capturing more what the story is and how the story changes depending on where you are. I mean, Kevin's spoken to how just within the inner city, you'll see various stories. And I think the partnerships we've done with MSCI and SAMRRA are starting to really bear fruit. And we're starting to see more and more, a trend analysis as opposed to just something that we've just done over like a period or two, which is very helpful. But then that also brings me to my next question, Kundayi, around how you see multifamily behave compared to office, compared to retail, compared to industrial, and how it performs maybe from an income perspective or any other key metrics that you would look at if you had your 50 Rand and you could only put it in one of them, what would be the key one that you look at from a metric perspective? Not that 50 Rand could buy you any of those, of course.
Yeah, but so I think the key difference between multifamily and the other sectors in commercial real estate is I think you find a much more, let's say a less volatile income profile. Income generation profile. So you don't get, even in good years, you tend not to get massive growth. Kevin, you spoke about a kind of 4% maybe 4 to 6% is where people have ended up, maybe less in some cases. But even if we had an absolute bull market and there was an undersupply situation, it's unlikely that you would see rents grow 15 and 20% in aggregate, maybe on a lease by lease basis. So, and at the same time, if you do have a economic downturn or anything like that, you find that multifamily is actually the sector you want to be in. What we have found as well is that, let's say, relative to industrial property, and in some cases office, the multifamily supply doesn't react as quickly. So people can build a building, but I think it does take a bit of time for you to get to kind of full stability or full lease up. Versus if you build a warehouse, it could take you 10 months or 12 months, and you typically have a tenant before you even open the doors. Or vice versa. One large tenant could just vacate that space too. So we find the supply response in other sectors to be much more rapid versus multifamily. So, and I think the way we've always looked at it is that's the sector you kind of hide out in when you think there's trouble on the horizon from a kind of economics perspective. And vice versa. When you think there's an economic boom, you want to get the growth out of the other sectors. But it's a much more stable profile.
What you're saying to me is that it's actually well primed for institutional capital, for pension fund capital. Yeah. It's a nice place to sit when you don't want the shocks and you want a nice steady something for your retirement clients. So
I think so. And I think in addition to that, we do need to see more institutionalization of the landlords, because I think that ultimately provides a better product to the consumer. So if we're all fragmented and we're all renting kind of individual units, we can get away with a lot. The UK has just come out this April, I think, with I think it's a renters bill or something like that, which kind of guides the rights of tenants. Some say it's a bit onerous and all that stuff, fair enough. But I think that it kind of paves the way for what kind of is a good standard of service that a consumer can get when renting a unit. You guys provide it because you're an institutional player, but most of the people don't. Most companies or
called moms and pops.
Yeah, exactly. So I think if it's institutionalized, you obviously end up with much more professionalism, and ultimately you get a better product for people at the end of the day.
Yeah.
Which I think
but
is
I'd like
important.
to suggest that most of SAMRRA's members are in
that category.
Provide the
the service level.
Yeah, the service.
Without a doubt, our members are definitely at the top end of service provision. I say it in every episode. It's swimming pools. In some cases, it's paddle courts. The portfolio that they've just bought also has the likes of proper greening. I think you've got grey water that waters all your rolling greens out in River Sands.
Don't forget the super tubes.
What's a super tube?
the kiddie super tubes
by the swimming pool. Oh, yes, the slides.
That's critical. Yeah. Critical infrastructure.
Critical infrastructure.
Sure. Okay.
No, I mean, being a parent myself, I know those are the decisions. You make those decisions before you make the real practical ones.
Yeah.
But you're right, Kevin. Those are the important ones.
But I think, speaking to the internationally, multifamily making up 13%. I would love to compare the development we're speaking about, the parks. I mean, which was developed by Century, which we acquired from Century and House. I mean, it's an absolutely magnificent lifestyle estate comprising 2,000 units.
Sure.
It's probably comparable to the best they have in the US, if not better.
I would say from a lot of the stuff I've seen, the quality of that product is better. The quality of, they are now listed, but I think there's an offer, the PIC is making an offer for Bowen. Some of that product is better than what I've seen in a lot of the multifamily stuff in the US. Germany, not great product at all. I've been shocked at
And
the
they are the
quality.
most established rental
Yeah,
rental
they're
market
a
in the
massive
world.
rental market. I think 60% of people are renters.
That's right.
The multifamily market is huge. But the quality of the product that people stay in is surprising. I haven't seen every single unit, but
The ones you saw
the
didn't
ones you
impress.
saw, and there were a couple of hundred, were shocking, to be honest.
Yeah. Sure, this is a great conversation and we really could go on, and unfortunately I have to wrap us up. But before that, I just want to get a sense, Kevin, you live inside the so-called engine room and have done so for the last 20 years or so. And Kundayi, you're analyzing it from the outside.
Yeah.
Where do you believe the biggest gap is between what you do and what he does? What are the investors missing? Where do we need to kind of like bring them into to help them invest more in the sector? And Kundayi, what would you say to our members around what it is they need to do to get themselves to a point where we're seeing more investment that we so desperately need, given this is a big social impact issue as well from a South African perspective?
Sure.
So maybe we're not as far apart as I thought we might be.
I'm glad we realized that today.
Sure. But I think historically one of the biggest differences has been the characterization of multifamily not being a defensive asset class.
Mm-hmm.
I think we've demonstrated that, particularly through, obviously through investment, SA Corporate's investment into AFHCO, into the space for the last 12 years now.
Mm-hmm.
It's a drum we've been beating for those 12 years to promote the asset class. And I think we've demonstrated that it is defensive. The incomes are predictable. I say this slightly tongue-in-cheek. When the riots happened in July 21, nobody burnt a house down.
No one burnt down residential.
Correct. Its collections have remained robust. Over the decade, vacancies are robust. You saw how quickly residential recovered after COVID. It bounced back a lot quicker, clearly than commercial, and in some cases even better than retail. And so, that I think that's been one of the biggest divides between us and them, if I can put it like that.
Yeah. I think we as the institutional investors have not, or in the listed market, have probably not done enough to understand the sector. I think there's this perception issue. I said I'm invested in the CBD, but I still have perception issues.
Yeah.
And you kind of help me just think about the range of incomes and profile of person that's in a CBD portfolio or suburban portfolio. So I think there's a perception issue about the type of tenant that probably needs to be handled better from our side. We just need to learn better.
Yeah.
And I think maybe also, people look at residential as 12-month leases and assume that at the end of every 12 months, everyone leaves and, you get a new batch of people come in. And it's not that. So
those are 10-month leases.
Yeah,
exactly.
10-month leases. So the fact that you've, highlighted, 2 to 3 year, that's not too far from an office portfolio. So we just need to kind of change how we think about that sort of story about the defensiveness. I think it's understood as defensive because people will stay in their flat or apartment or house, whatever. But that income probably lasts longer than maybe what we've perceived it to be. So anyway, I've learned something today. So,
and I think, as you said earlier, that somebody will stop paying their DSTV before they stop paying for the roof over their head.
Yeah, sure.
And so that is a real...
Sure. It sounds like this has ended up as the myth-busting episode.
Sure enough.
Maybe the two of you have become the myth-busters of the investor and the operator.
Multifamily myth-busters.
I hope so, and I'm hoping that this was educational more than anything, because I glibly say myth-busting, but the idea is that one has learned something that they either perceived as problematic, and turns out it's not as problematic as it was. Thank you to both of you for taking the time out to join me and to have this conversation. And thank you to you, our viewer, listener, who has taken the time to be educated and have myths busted on this episode.
Thank you for joining us for this episode of the Multifamily Series podcast, proudly brought to you by Old Mutual Alternative Investments.